Investing. It sounds like a golden ticket to financial freedom, right? You've probably heard stories of people making millions, quitting their jobs, and living a life of luxury, all thanks to some smart investment decisions. But here's the uncomfortable truth. Investing isn't always the glamorous, straightforward path it's often made out to be. In fact, it's often risky, unpredictable, and requires a deep understanding of not just the market, but yourself. Let's break down the uncomfortable truths that every investor, whether a beginner or seasoned, needs to know. 1. Investing is not a get-rich-quick scheme. One of the most common misconceptions is that investing will make you rich overnight. Sure, there are those rare stories of people who bought Bitcoin at $1 or invested in Apple when it was a penny stock, but these are the exceptions, not the rule. Most successful investors take decades to build their wealth. The truth is, consistent, long-term investments grow wealth over time. The real winners are those who are patient, disciplined, and strategic, not the ones chasing trends or looking for quick paydays. The key is to understand that investing is a marathon, not a sprint. Short-term gains can sometimes happen, but long-term growth requires time, planning, and persistence. 2. You will lose money. At some point. This might be one of the hardest truths to accept. You will lose money at some point in your investing journey. Every investor, no matter how experienced or well-informed, faces losses. It's inevitable. The stock market goes up and down, often unpredictably. The key to surviving these losses is not letting them scare you away. Successful investors don't panic when markets dip. They know that markets are cyclical, and downturns are part of the game. By keeping a level head, they ride out the rough patches and position themselves to profit when the market recovers. The real challenge is managing your emotions, resisting the urge to sell in a panic or buy out of fear of missing out. 3. You can't predict the market. If you think you can outsmart the market or predict its movements, think again. Even the best financial analysts and economists can't consistently predict when a stock will rise or fall. Sure, they may get lucky a few times, but no one can time the market perfectly. Market volatility is influenced by a wide array of factors: political events, natural disasters, changes in interest rates, and even public sentiment. Trying to predict every swing is a fool's errand. Instead of chasing short-term trends or trying to guess what the market will do next, focus on long-term strategies that align with your goals. 4. Diversification is essential, but not foolproof. Diversify your portfolio is advice you've likely heard time and time again, and it's solid advice. Diversification helps spread risk, ensuring that if one investment tanks, you're not left with nothing. But here's the uncomfortable truth. Diversification doesn't guarantee you won't lose money. Even diversified portfolios can take hits during market-wide downturns. For example, during the 2008 financial crisis, almost every asset class took a beating. While diversification helps minimize risk, it doesn't eliminate it. The best strategy is to diversify thoughtfully and be prepared for the unexpected. 5. Fees eat away at your returns. Many investors don't pay enough attention to the fees they're paying for their investments. Whether it's brokerage fees, fund management fees, or even tax penalties, these seemingly small percentages can add up and significantly reduce your returns over time. For example, if your investments are growing at 7% annually, but you're paying 2% in fees, you're losing nearly 30% of your potential earnings to fees over 20 years. The truth is, high fees can slow down your wealth-building process, so it's crucial to keep an eye on them and choose low-cost investment options whenever possible. 6. The power of compound interest takes time. We've all heard about the magic of compound interest, how your money can grow exponentially as your earnings begin to generate their own earnings. But the truth is, compounding doesn't work miracles overnight. It takes time, lots of it. In the early years, the growth might seem slow, even negligible. But over decades, the power of compounding becomes significant. This is why starting early is so important. The earlier you invest, the more time your money has to grow, and the more you can benefit from compounding. It's not about timing the market, It's about time in the market. 7. You need a plan, not just a wish. Investing without a clear plan is like going on a road trip without a map. You might end up somewhere interesting, but it's more likely you'll get lost along the way. Many new investors make the mistake of jumping into the market without clear goals, hoping that they'll just figure it out as they go. The uncomfortable truth is that successful investing requires a well thought out plan. What are your financial goals? How much risk are you willing to take? What's your time horizon? Do you have an emergency fund? Answering these questions and crafting a strategy around them is essential. Investing without a plan is gambling, not wealth building. 8. Risk tolerance isn't what you think it is. Everyone thinks they're fine with taking risks until they start losing money. Your true risk tolerance only reveals itself when the market turns against you. That's when you'll know whether you can stomach the volatility or whether you'll be tempted to sell everything at a loss. Understanding your actual risk tolerance is essential. You might think you can handle risk, but if you're losing sleep over market dips or obsessively checking your portfolio, it may be a sign that your investments don't align with your comfort level. It's critical to be honest with yourself about how much risk you're genuinely willing to accept and adjust your investment strategy accordingly. 9. You are your own worst enemy. The biggest threat to your investment success isn't the stock market, it's you. Human psychology plays a huge role in investing. Fear, greed, overconfidence, and impatience are powerful forces that can lead to poor decision-making. For example, many investors buy when the market is soaring, driven by the fear of missing out. Then, when the market crashes, they panic and sell, locking in their losses. This cycle of emotional investing is one of the biggest reasons why average investors underperform compared to the broader market. The key is to remove emotion from the equation. Having a clear plan, sticking to it, and staying disciplined, even when things get rocky, is what separates successful investors from those who fail. 10. There's no such thing as a safe investment. Finally, the last uncomfortable truth. No investment is completely safe. Even so-called safe investments like government bonds or savings accounts carry risks such as inflation risk, the risk that inflation will outpace your returns and erode your purchasing power. The reality is that every investment carries some level of risk. The goal isn't to avoid risk altogether, it's to manage it wisely. By understanding the risks associated with different investments and making informed decisions based on your goals and risk tolerance, you can increase your chances of long-term success. Conclusion: embrace the uncomfortable truths. Investing can be one of the best ways to build wealth, but it's not without its challenges. By acknowledging these uncomfortable truths and preparing for them, you can approach investing with a clear head and a solid plan. Remember, it's not about finding shortcuts or guarantees. It's about understanding the risks, managing your emotions, and staying committed to your long-term goals. Investing is a journey, and like any journey, the road won't always be smooth, but it will be worth it in the end.